His name was Daniel Sorensen, Senior Portfolio Manager, Global Equities, 12 years inside the fund. He joined at 26, straight out of the Norwegian School of Economics, when the assets under management were just under $600 billion. By the time he turned 38, the number had crossed $1.4 trillion. On paper, his job was precise: allocate capital across public equities, optimize long-term returns within a strict risk framework, translate macro uncertainty into position sizing. The mandate sounded technical, almost mechanical, but the scale distorted everything. A 0.1% shift in allocation wasn't a trade. It was the equivalent of moving billions across continents, sectors, and currencies. A decision made in a quiet Oslo office could reprice industries in Sao Paulo, Seoul, or San Francisco. On a Tuesday morning in late October, Daniel sat in a glass-walled meeting room overlooking the harbor. The agenda was routine: quarterly rebalancing. Nothing unusual, no crisis, no breaking news, just numbers that needed to be adjusted. He stared at a single line in the report longer than necessary. Exposure to U.S. tech had drifted above target, not dramatically, by 0.6 percentage points. In any other fund, it would be noise. Here it represented roughly $8 billion. The correction was obvious: trim positions, rebalance, stay within mandate. He hesitated, not because the math was unclear. The math was trivial, but because the decision, however small it appeared, would cascade. Selling even a fraction would signal something. Algorithms would pick it up. Liquidity would adjust. Counterparties would infer intent where none existed. He approved the adjustment. The meeting moved on. No one commented on the pause. This was how most days worked: clean decisions, executed within a system designed to eliminate ambiguity. And yet, over time, Daniel began to notice a quiet friction between what the system demanded and what intuition suggested. It didn't present itself as conflict. It presented as a question that never fully resolved. Why did every decision, regardless of size, feel heavier than it should? At first, he assumed it was experience. Responsibility accumulates. Scale amplifies consequence. This was expected, but the feeling didn't stabilize. It intensified. By his ninth year, Daniel was managing a slice of the portfolio larger than most hedge funds in Europe. His performance was consistently within the top quartile internally. No major drawdowns, no reputational risk, no controversy. And yet, he noticed something peculiar. His compensation barely moved. The increments were structured, predictable, almost indifferent to individual outcomes. The variance between a good year and an exceptional one was marginal. There were adjustments, of course, but they followed bands. Narrow ranges, predefined ceilings. He didn't question it initially. The fund was public. The mandate was long-term. The culture emphasized stability over individual reward. It was part of the identity. But over time, the disconnect became harder to ignore. External recruiters began to reach out, quietly at first, then more directly. Sovereign wealth funds are not isolated systems. They exist within a global talent market. And in that market, Daniel's profile had a price. The numbers he heard were not incremental differences. They were multiples. He declined every conversation, not out of loyalty, at least not consciously, but because the alternative felt abstract. The fund was not just an employer, it was an institution. It carried a sense of permanence, a perception of operating above the short-term incentives that defined much of the financial industry. That perception was carefully constructed, and it was only partially true. The tension crystallized during a routine performance review. His manager, Ingrid, had been with the fund longer than he had, calm, precise, structurally aligned with the system. She walked him through the evaluation: strong performance, consistent decision-making, high trust. Then she mentioned compensation. It would increase, slightly, within band. Daniel asked a question he had never asked before. What would it take to move outside the band? Ingrid didn't answer immediately. Not because she didn't know, but because the question itself sat outside the logic of the organization. "It's not designed that way," she said eventually. That sentence stayed with him. Not designed that way. It implied something more fundamental than policy. It suggested architecture. The system wasn't underpaying him by accident. It was calibrated to do exactly that. This is where the underlying mechanism begins to reveal itself. Large sovereign funds operate under a constraint that is rarely articulated directly. They must balance two opposing forces. On one side, they manage enormous pools of capital that require highly skilled professionals. On the other, they are public institutions, accountable to political systems that are inherently sensitive to perceptions of excess. The result is a structural compromise. Compensation is deliberately compressed, not arbitrarily. systematically. This creates what can be described as the invisible ceiling. It is not a formal limit. There is no document that defines it explicitly, but it exists as a boundary that is enforced through culture, policy, and perception. Within this ceiling, performance is recognized, but only to a point. Beyond that point, additional value does not translate proportionally into reward. The system is not trying to maximize individual output. It is trying to maintain institutional legitimacy. And legitimacy has a cost. Daniel began to test this hypothesis. He spoke informally with colleagues in different departments: fixed income, real estate, risk. The patterns were consistent. High performers clustered at the top of their bands, but the bands themselves remained narrow. He compared internal compensation data with external benchmarks. The gap was not subtle, it was structural. He started to understand that the system relied on a specific type of employee, not the one who maximizes income, but the one who internalizes the mission. This is where the psychological layer emerges. The fund attracts individuals who value stability, prestige, and long-term impact. It selects for a certain mindset: analytical, disciplined, but also in a subtle way compliant with structural constraints. Over time, this creates a feedback loop. People who are comfortable within the system stay. Those who are not leave early. The invisible ceiling does not need to be enforced aggressively. It is self-selecting. Daniel had passed through this filter without noticing it. Until now. The turning point came not from within the fund, but from outside. A London-based asset manager made an offer. It was framed as an opportunity to lead a global equity strategy with a mandate smaller than what he was used to, but with significantly more flexibility. The compensation package was, by any objective measure, disproportionate to his current one. He did not accept immediately. Instead, he asked for time. Not to negotiate, to think. He returned to the office the next day and looked at his screens differently. The positions were the same, the models unchanged, but the context had shifted. For the first time, he saw his role not as a fixed point, but as one node in a broader system of incentives. He scheduled a follow-up conversation with Ingrid. This time, the tone was different. "I've been approached," he said. She nodded. This was not new. "I'm not asking for a counteroffer," he continued. "I'm trying to understand the logic." Ingrid listened. Daniel articulated what he had been observing: the compression, the ceiling, the gap between internal and external valuation. He expected resistance or deflection. Instead, Ingrid was direct. "The system is designed to retain a certain type of person," she said, "not necessarily the highest paid one." It was not defensive, it was descriptive. "And if that type changes?" Daniel asked. "Then the system adjusts slowly," she replied. "Or it doesn't." There was no tension in the room, only clarity. This was the moment of collision. Not between Daniel and his manager, but between an individual and a structure that had no intention of changing quickly. He realized that his discomfort was not a signal of misalignment with his role. It was a signal of alignment with a different system. The offer from London was not just a financial upgrade. It represented a different set of rules, one where performance and compensation were more tightly coupled, where the ceiling, if it existed, was higher and less rigid. But it also came with trade-offs: shorter time horizons, higher volatility, less institutional backing. Daniel spent a week mapping these systems, not emotionally, analytically. He listed constraints, incentives, and likely trajectories. He modeled not just income, but optionality, not just risk, but control. At the end of that process, the decision became almost mechanical. He declined the offer, not because the system he was in was better, but because he understood it. And understanding changed the equation. He no longer interpreted the invisible ceiling as a flaw. He saw it as a parameter, a boundary within which a certain type of career could exist. Months later, Daniel was promoted to Chief Investment Officer. The role came with more responsibility, but not with a proportional change in compensation structure. The ceiling moved slightly, but it remained. From that position, the system became even clearer. He now participated in decisions about compensation policy. He saw the constraints from the other side: political sensitivity, public scrutiny, institutional reputation. He realized that the system was not inefficient. It was optimized for a different objective, not maximizing individual wealth, but preserving long-term trust in the management of national capital. This is the part that is rarely stated explicitly. When you work inside a $1.4 trillion sovereign fund, you are not primarily optimizing returns. That is the visible function, the explicit mandate. The hidden function is stability, stability of perception, stability of governance, stability of narrative. Every decision, including how much you are paid, is filtered through that lens. Daniel stopped expecting the system to behave like a private market, because it wasn't one. It was something else entirely. And once that becomes clear, the tension dissolves. Not because the constraints disappear, but because they are no longer mistaken for anomalies. They are recognized as design.